Welcome to the Deep Dive. We're looking at the Q2 2025 earnings call today. Happened midday, July 31st.
Right.
And this one really set up a classic trade-off for investors, didn't it?
It really did. You had, strong momentum on the top line, generating revenue.
Yeah, impressive growth.
But then, bam, significant pressure hitting the bottom line. Profitability challenges.
And the market's reaction told the story pretty quickly.
Oh, absolutely. Swift and negative. It was clear investors zoomed right in on the underwriting side.
So our job today is to really dig into why those profitability numbers were so disappointing, especially when the underlying growth looked, well, pretty good.
Exactly. What went wrong on the cost side?
Okay, let's unpack the headline financials first, because they were certainly mixed.
Mixed is putting it mildly.
Revenue came in at $246.3 million.
Which was a beat against consensus. Solid beat, actually.
Ended up, 13-14% year over year?
That's right. So, on the surface, generating business, no problem there.
Yeah, but then you get to the bottom line, adjusted EPS.
Yeah, and here's where the wheels came off a bit. $0.48.
Which missed consensus estimates by nearly 50%.
Almost half. And maybe more importantly, that's a steep 56% decrease compared to last year.
Wow, 56% down. That's not just a blip.
No, that signals a real headache. And this divergence, revenue beat, massive EPS miss, that's what triggered the sell-off on the call day.
So the market's saying, we don't care how much premium you write if you can't make money on it.
Precisely. The concern right now is all about the escalating costs and the profitability outlook.
Even though book value looked okay.
Book value progress was strong, yeah. But it got completely overshadowed by these loss trends. And the big one, the high combined ratio, market sentiment is definitely cautious.
Okay, let's get into the weeds then. The expense side. Starting with that key metric, the combined ratio. What was it and what drove it?
Right, the combined ratio, that's where you see the underwriting pressure laid bare. It hit 105.6%.
Okay, over 100. Not good.
And if you strip out a one-time benefit from something called a loss portfolio transfer, or LPT.
Which is like offloading some old liability.
Exactly. Excluding that, the ratio was actually worse, 106.4%.
Wait, 106.4%?
Wow.
So for every dollar in premium, they're paying out about $1.06 in claims and expenses.
That's what it means on an operating basis for that quarter. They're losing money writing policies at that level.
Ouch. What pushed the loss part of that ratio so high? What's the smoking gun?
The smoking gun is very specific, California, and specifically a rapid rise, as management put it, in cumulative trauma claims there, CT claims.
Cumulative trauma, so not one big accident, but wear and tear type injuries developing over time.
That's the one. And it's become a major issue in California's workers' comp system.
So how did management react in the quarter to this?
Immediately. They raised their current year loss pick on the voluntary business, that's the business they choose to write, up to 69%.
69%, that sounds high. What was it before?
It was 66% in Q1, so that's a 300 basis point jump in one quarter.
That kind of jump tells you they're seeing something structural, not temporary.
Absolutely. It's a direct and you could say quite conservative response to that surge in California CT claims. But that wasn't the only big move they made on the reserving side.
Right. You mentioned a reserve action. Something about $50 million being reallocated. That sounds significant.
It was very significant. What they did was identify over $50 million in favorable development from older claims, think accident years 2020 and prior.
So money they'd set aside previously, but now didn't expect to need for those old claims.
Exactly. They felt those older years were resolving better than expected.
Yeah.
But instead of just releasing that $50 million plus to boost current earnings.
Which would have helped that EPS number.
Tremendously. But instead, they took that favorable development and reallocated it internally to bolster the reserves for the more recent accident years, 2022 through 2024.
Ah, the years presumably being hit by this new wave of CT claims.
Precisely. So they're using strength from the past to shore up defenses against current pressure. Very prudent, very conservative.
But the immediate impact?
The immediate impact was painful for the reported numbers. Because they moved that money internally, they reported no net prior year reserve release in Q2. Normally, you might expect some positive development from older years to flow through.
So that reallocation, while maybe the right long-term move, directly contributed to the big earnings miss this quarter.
Correct. It signals confidence in the old reserves, but also acknowledges the rising pressure on the newer ones.
Does this mean their initial estimates for 2022-2024 were just wrong? How do we trust future guidance?
That's the key question now. It's about execution credibility going forward. And management knows this.
So what are they doing about it?
They announced a full actuarial study for Q3. They're going to take a deep dive, recalibrate everything pricing, reserving based on this new CT claims reality.
Okay, so Q3 results and that study will be critical.
Absolutely crucial for rebuilding investor confidence.
Right, despite all this pressure on the loss side, the call wasn't all bad news. They did talk about strategic discipline, underlying strength.
Yes, and that's important context. The message was clear. Focus on profitability over just chasing premium volume.
We saw that in the numbers, right? Gross written premium was actually down slightly.
Down 2.2%, yeah. That wasn't an accident.
They're deliberately pulling back.
They are. Tightening underwriting standards, stepping away from certain classes of business, especially some middle market new business, and certain areas where the profitability outlook is murky, shrinking exposure where the risk reward isn't right.
But the core business, the policies they kept, still seems healthy.
It does. Even with that pullback on new business, net premiums earned still grew 5.6%.
Okay.
And maybe more telling, policies in force hit a new record over 134,000. That's up 4.6% year over year. So they're retaining and still growing the overall policy base.
And what about the expense side, separate from claims?
Yeah.
Any good news there? Because that's the other part of the combined ratio.
Yes, definite progress on efficiency. They mentioned automation, customer self-service tools, using AI.
The usual suspects for cost savings.
Right, but it seems to be working. The commission expense ratio dropped year over year from 13.9% to 13.2%.
Okay, that helps.
And the underwriting expense ratio, things like salaries, rent, systems, also improved, down from 22.4% to 21.7%. So they are controlling the costs they have direct control over.
Which is crucial when the loss ratio is under pressure. And the balance sheet itself, capital position.
Still looks rock solid. Net investment income held steady around $27 million, benefiting from higher interest rates.
And book value.
Book value per share, including a deferred gain they carry, was up almost 13% year over year, reached $49.44.
That's strong growth, often overlooked when earnings miss badly.
It often is. And this capital strength allows them to return cash to shareholders.
Through dividends and buyback.
Yep. They maintained the $1.32 quarterly dividend, and they were active buying back stock. Returned $31.4 million total to shareholders in Q2.
How much stock do they buy back? That's always interesting when the price is falling.
In Q2 itself, they bought back about 482,000 shares at an average price of $48.08. And they didn't stop there. Through July, after the quarter ended, but before the call, they bought another roughly 229,000 shares at an even lower average price, around $46.44.
So management is putting its money where its mouth is, signaling they think the stock is cheap.
It certainly seems that way. And they still have firepower left, about $99 million remaining on their current buyback authorization.
That provides some support for the stock price, doesn't it? A significant buyer in the market.
It definitely puts a potential floor under the price, yeah.
Okay, so stepping back. This whole quarter's volatility seems laser focused on one issue in one place. California cumulative trauma claims. Why is this one specific risk in one state having such an outsized impact?
It really highlights jurisdiction risk in insurance, especially workers' comp. California is, well, it's different.
How so?
It allows these cumulative stress claims, the CT claims we've been talking about, and crucially, it lets workers file these claims after they've left the job, post-termination claims.
Which likely encourages more claims and more lawyers getting involved.
Exactly. It leads to much higher attorney involvement compared to other states, and that drives up claim frequency.
So it's not necessarily that workplaces are suddenly much less safe.
Management was clear on this point. They see this primarily as a frequency issue, not a severity issue. The cost per claim isn't necessarily exploding, but the number of claims is.
And you mentioned it spreading.
Yeah, this is fascinating. Historically, these CT claims were really concentrated down in Los Angeles.
Yeah.
But since COVID, with the shift to using remote hearings for workers' comp cases...
Like Zoom court?
Kind of, yeah.
Right.
That's enabled the law firms specializing in these claims to expand their reach. Now they're seeing these claims spread significantly into the Bay Area and up to Sacramento.
Wow, so a change in legal logistics is actually changing the geographic risk profile.
In real time.
Yeah.
And this CT claim surge is masking what might otherwise be good news.
How so?
Management pointed out that their non-CT claim frequency in California is actually still trending down.
So the underlying trend, excluding this one specific issue, is positive.
It seems so, consistent with trends they see outside California, too. But this CT wave is just overwhelming that right now.
So what's the path forward? How do they fight this? Are they just stuck waiting for California to change its laws?
Well, they're hoping for legislative change, certainly. The insurance commissioner has actually urged the governor to look at reforms to combat this trend.
Is there any immediate relief?
On the pricing side, yes. The commissioner approved an 8.7% rate increase for them effective September 1st. That will start earning in and helping the numbers.
But legislative reform could take years, if it happens at all.
Right. So management's stressed they aren't just waiting. They have their own multi-pronged approach.
Meaning?
More rate increases beyond the approved 8.7%, even tighter risk selection, continuing to pull back from problematic areas, and very specific claims management strategies designed to fight these CT claims more effectively, using levers they control now.
Okay, makes sense. Fix what you can fix internally while hoping for external help.
That's the strategy.
All right, this brings us to our non-financial advice segment. We've got this complex picture. Strong capital, good expense control, strategic pullback. But hammered earnings due to this localized California issue. Is there an outrageous but plausible trade in here?
I think there might be. Look, the market reacted very negatively, right? Sold the stock off hard.
With low book value even.
Right. And it seems focused entirely on the bad news, maybe missing the nuance that the $50 million reserve hit wasn't lost money. It was just moved internally.
Reallocated strength.
Exactly. And we know the capital position is strong, and that buyback is actively running with nearly $100 million left.
So the idea is the market overreacted to a fixable localized problem.
That's the core of it. It feels like an overestimation of the permanent risk here. So how about a relative value play?
Okay, I'm listening.
We construct a paired trade. You go short the broader P&C insurance sector, maybe using the SPDR S&P Insurance ETF, ticker KIE.
Short KE. That sector's been pretty strong over the last year, hasn't it?
It has. That's part one. Part two is you go long the company stock we've just been discussing, the one that just disappointed.
Wow, okay. Short the strong sector, buy the weak stock. Explain the thesis there. That is outrageous, but plausible.
The thesis is the market is punishing this specific stock too much for a problem management seems capable of addressing through pricing. That 8.7% hike is already approved and through their own actions, plus the upcoming Q3 study results. It's a localized California issue, not necessarily a fundamental flaw in the whole business.
Okay.
Meanwhile, the broader sector ETF, KIE, might be facing its own headwinds, maybe unpriced risks from general inflation, catastrophe costs, things that affect everyone that haven't hit sentiment yet. And crucially, this specific stock has that big buyback acting as a cushion.
So you're betting that this company's internal fixes and capital return will close the valuation gap faster than any potential broader sector issues emerge?
Essentially, yes. You're betting on management execution and the buyback, bridging the gap until those rate hikes earn in, and the Q3 study hopefully clears the air.
Interesting. Definitely fits the bill. So to wrap up, we really covered a quarter defined by this core tension, didn't we?
Absolutely. Excellent growth metrics, solid discipline on expenses and capital return.
All pitted against this really material cost pressure coming almost entirely from these California CT claims.
Which led directly to that major earnings miss and the negative market reaction.
So the focus now shifts completely to execution, right? And that Q3 actuarial study.
It's all about credibility now. Investors need to see sequential improvement in that combined ratio. They need reassurance from that Q3 study that management has gotten its arms around this California problem.
Okay, and let's leave our listeners with a final provocative thought to mull over.
Go for it.
If, and it's an if,
Yeah.
but if legislative reform does happen in California, maybe faster than people expect, how much hidden strength, how much latent reserve redundancy is actually sitting inside those recent accident years because of that conservative $50 million reallocation they just did?
That's a great question.
And how quickly could that conservatism flip, be recognized as excess capital, and completely reset the narrative around the stock?
That potential future reserve release. Yeah, that could definitely be a game changer down the road if things break right in California. Something to watch.
Indeed. Thank you for joining this deep dive.